Hi, this is Brian Vendig, president of MJP Wealth Advisors, recording a video for you in January of 24, and thought it would be a great time to reflect on how we ended last year and what we expect over the next 12 months in the new year 2024. But before I go there, I'd just like to thank you all for your ongoing relationship and the trust that you put in our firm. We really appreciate welcoming you all into the new year and having an opportunity and privilege to manage your wealth and help you achieve your short-term as well as your longer-term goals. So with that being said, I'm going to share my screen and walk you through a few slides, I promise not too many, which will help to give us a sense of where we think there's opportunities in the market and talk about some of the risks just to be aware of for the new year. So last year, we had a pretty strong close to the financial markets, both in stocks and bonds. But one phenomenon was the disparity of returns that existed over the course of the year. I think the media has done a great job in playing up the Magnificent Seven, but I'll characterize it more as a frenzy that impacted the market last year, focusing on investments in artificial intelligence and where the opportunity of that innovation might lie. Our view is that, yes, artificial intelligence and owning technology stocks as part of your portfolio is something that does make sense, but we need to be focused on the fundamentals of those companies and making sure that the valuations seem reasonable. And last year, we really saw a huge disparity of return between growth stocks and value stocks, as well as large companies and small companies. And on record, it was actually one of the greatest disparity of returns between these types of asset classes. That's why I'm going to hint at that might be an opportunity for 2024 when we consider where we're going to be allocating to equities in the new year. Now, specifically, last year was also a really interesting year because we received about 90% or so in return coming from 7 mega cap technology stocks. A lot of the names that you all know: Amazon, Alphabet, Meta, even NVIDIA, and Tesla, names that have been highly reported in the news. But the reality is the majority of stocks last year really didn't keep up with those large 7 mega cap and consumer discretionary stocks. And when we finished the year, most of the stocks in the S&P 500 actually underperformed and was at such a high level that we haven't seen in almost 20 years. So again, when we think about this year ahead, it's possible that we might see more participation coming from stocks of other sectors, and that might create an opportunity, we think, for the equity markets moving forward. But I'm going to go into a couple of reasons why we believe that might be the case. So again, just to spell out last year one more time, you can kind of see on this chart where those contributions of returns have come from. And again, we manage broadly diversified portfolios. So that means that we do have an indexing to those growth contributors from last year, but we're also looking at valuations as well as earnings forecasts of growth forecasts for companies coming from other sectors. And just because we had this concentration in return the last year, when we look at things historically, it doesn't always necessarily mean you want to over-index just to one sector at the risk of others, because as we know, market moves very fast and things change, and we want to make sure that we are allocated to areas where we think the puck might go, so to speak, over the next 12 months. So as we move forward, just want to reflect that when we got to a point last year, and this was in the fourth quarter, we started to hear from the Federal Reserve. One of the major influences last year in the financial markets, what was going on in the financial system. So over the course of the year, from January through the end of October, the Fed was pretty much saying that they're going to hold rates higher for longer as they're fighting inflation. And we've seen over the last year or two that the Fed has increased rates 5.5% as a means to try to slow down demand in the economy, as a means to try to lower inflation, and also give supply chains a time to rebuild their inventories, hoping that inflation will come down. And what we've seen over the course of last year was that, yes, inflation did come down while rates were maintained at a steady level. And also, if you remember, back in March of last year, we had two banks fail, and there was concern about the banking sector. And is the U.S. economy going to go into a recession? Well, as the year went on last year, we saw that a recession did not occur because consumers were spending. But we also saw that the Federal Reserve changed their policy decision and where they're going to go with rates in 2024 that they pre-announced in December and hinted at in November. Well, when that policy shift was announced in the market or hinted to in November, we really saw a broadening out in return that came from those other sectors of the market that didn't participate, that I was hinting at before. So it wasn't just staying with the growth stocks. It was looking at other areas of the market, such as other sectors outside of the technology areas, such as healthcare or industrials or financials, or even looking at some of those smaller companies that I was hinting at. And so in the fourth quarter, we saw what's called a broadening out or a larger rally in the market that impacted other sectors. Because I think investors over time have been used to the fact that when the stock market goes up, they expect all boats to rise with the tide. Well, that really wasn't the case for the majority of last year, and we only saw that towards the end. However, as we think about 2024, we think there's an opportunity for a broadening out for other sectors to participate because the Federal Reserve is hinting at that they're going to be cutting rates at some point this year, which I'll be getting to. And I think that might actually help the equities as well as the bond market. So when we think about this year, just switching gears and talking about 24, I think the main things to focus on is first, earnings. Earnings helps to support valuations in the market. And earnings is another way of saying the profits that are expected to be made by publicly traded companies over the next 12 months. And right now, earnings forecasts for this year are that there should be growth in earnings somewhere between, consensus estimate is somewhere between 10 to 12%. It's possible those numbers are a little bit on the high side because they might not be taking into account that the consumer might be slowing down in their spending. We might expect a little bit of a slowdown in the services sector over the next 6 months in the U.S. economy. However, because those earnings forecasts are more robust for 2024 as compared to 23, we can see here that the stock market outlooks actually are quite positive over the next 12 months. And we're definitely in the camp that we think that the equity market has a chance to appreciate because inflation should be coming down over the course of the year. We're expecting core inflation to end this year at around 3%. We expect the Fed to cut interest rates this year. However, I think those cuts are going to come in the second half of 24. And we do expect companies in other sectors outside of technology to be more of a contributor for earnings growth, which should cause a rise in equity values in some of those areas that are still playing catch up for last year. The other thing I want to mention, I know I've been talking quite a bit about equities, but I also want to talk about the bond market. Now, the bond market is also an area where we have fixed income in your portfolios. Because the Fed was raising rates over the last 2 years, we were trying to keep duration of bonds or the time period that bonds mature very short because we were trying to reduce the impact of bond prices going down as interest rates are going up. Now we think there's actually an opportunity for those things to reverse this year, where interest rates come down and as a result, bond prices will go up. So a majority of our portfolios in your account have durations anywhere between 2 to 7 years on average. And we own treasuries and we own other types of bonds in your portfolios. And so if we think about interest rates falling, let's say 0.5%, or in this case, 50 basis points or 50 BP on this slide, it's possible that over the next 12 months, bonds could have a very favorable year and have returns anywhere between 5 and 8% on average. Now, it is possible that we're going to see different points in time over the course of the year where inflation might tick up and interest rates might tick up. And we've seen a little bit of that coming off at the end of last year. And we actually see that as an opportunity to add duration or add more to longer dated bonds so that we can improve the performance of the fixed income portfolio while we're staying broadly diversified on the equity side. So expect some changes over the course of the year where we might be adding duration to bonds to improve the performance from the fixed income, while on the equity side, trying to stay pretty balanced between those mega cap growth stocks and then also investing in some other areas of the market that we'll consider more value stocks that haven't participated as much over the last 12 months. Now, as we go back here and we take a look at where, again, the outlook for earnings are over the course of the year, is as the year progresses, the outlooks is that earnings should increase sequentially quarter over quarter throughout the year, which I think is a good news item. Part of that is the fact that a lot of publicly traded companies have recapitalized their balance sheets in the past when interest rates were low. We're also seeing that supply chain levels and inventory levels have improved, which also lowers the cost of goods. And we've also seen that labor costs have moderated. Some of those wage increases that were impacting margins have also stabilized. So again, I think, what we're listening to in the midst of earnings season right now is that we're going to get a significant amount of earnings reports over the next 2 weeks. And we're paying attention to those outlooks for earnings. We're paying attention to what publicly traded companies say about the consumer. And we're also listening to how companies are looking to innovate and expand their margins moving forward. Now, the one thing, again, as I mentioned, which is a little bit of a disconnect that's going on right now in the market, this slide is showing, is that when you think about that broad-based rally that we saw in the market towards the end of last year, the market participants are thinking that the Federal Reserve is going to cut interest rates around 6 times over the course of 2024, and that those rate cuts might start happening in the first half of 24. We're actually more in the camp thinking that we'll get about 3 rate cuts from the Fed as they announced in December, because inflation should sequentially come down over the course of the year. But right now there's a disconnect between market expectations versus what the Fed said. So what we're expecting is that over the next 6 months, there's definitely going to be some volatility in the market as investors are trying to recalibrate those expectations and make those reflective appropriately, both in yields and bond prices, as well as in stock prices as well. And we've just seen over the last couple of weeks through the course of January that we ended last year, as an example, on rates on the 10-year Treasury at around 3.8, 3.9%. And now we're sitting at around 4.1% on the Treasury, approximately as of today, on January 23rd. Well, that increase in rates is just because the expectations are changing, realizing that maybe the Fed's not going to cut rates as much because inflation is still a little sticky and not coming down as fast as people expect. And maybe market participants got a little bit too excited back in November and December when they heard from the Fed regarding a policy change. So this is, again, something that's going to impact market valuations. But we think if you think about it over a 12-month perspective, there should be good news coming for both stocks and bonds, because the Fed is going to moderate on their rate policy and cut rates a couple times this year. And again, this just gives us a reminder of the path of where we've been on inflation, and also thinking about how the economy is doing. We've seen positive GDP growth over the last several quarters. We are expecting that as GDP gets announced this week, that we'll probably see more of like a 2% growth moving forward for the economy, which is actually getting back to where we were pre-COVID. And also the fact that inflation has come down primarily due to supply chain improvements and inventory levels stabilizing around the world, that now the next impetus of getting inflation lower is seeing that consumer demand will slow relative to consumers now being a little choosier on price. And again, this slide here is just to remind us that inflation is sticky. Wages recently have shown to grow more month over month than expectation. And there's different points in time relative to the cycle of the economy where wages dip, wages accelerate, and the same can be said for the housing market as well. And housing and home prices and real estate prices are two of the more stickier inputs in inflation. And look, we expect inflation to come down, but wages and housing is going to help to keep inflation a little sticky, which I think is why the Fed's going to take a little bit more time over the next several months before they start cutting rates, because they really want to make sure that we're on a path for lower inflation and slower growth coming from the U.S. economy. So what does that mean in the end for the economy over the balance of the year? Well, market participants right now are still expecting a soft landing with the economy, meaning that the stock market and the other financial markets are stable relative to the Fed changing policy, and that we're still seeing slow growth coming from the economy. I still think there are some risks that are out there, primarily due to the uncertainty of consumer spending, and also even the Fed may be getting concerned if inflation ticks up again over the next several months. So there are some that are still talking about that there is still a 40 to 50% probability of a recession being out there over the next 6 months. That is still possible, that there is some sort of economic slowdown that could come in the near future. But if that does occur, again, I've been telling investors, think about it more as an economic malaise, a mild slowdown coming from the services sector, not something that's going to bring back memories of 2008. And rather, I think the market will come back to the fundamentals and say, what do profits, what are inflation and rates telling us? And I think that is actually something that is a little bit more important to focus on over the longer term. So as we continue to get updates from earnings, the Fed, other economic inputs, we will continue to keep you posted. But I think the tone of this message today is that we are looking to make some changes to the portfolio, that when the market dips, we're looking to buy into those areas that didn't participate last year as much in the stock market. We are looking to add duration or maturity to our bond portfolio to take advantage of rates decreasing and getting some additional price appreciation. And we're going to keep a close eye on the economic numbers, earnings, and of course, what's going on in the political and geopolitical season. So we'll continue to keep you informed, but thanks so much for your time. Hope you have a great year ahead, and looking forward to the next discussion.